In this video, I'm going to break down the best fair value gap strategy and show you how fair value gaps are meant to be used inside a real trading model. And I want to be clear about what I meant by that. One of my students, Wolf, made $10,000 in one day using this exact framework, not by chasing fair value gaps, but instead using them correctly inside of my Trinity model, because this is where most traders get tripped up. Fair value gaps aren't unreliable. They're not entries, they're not signals, and they're definitely not something you just mark and hope price reacts to. That's why you see so many traders have mixed results with fair value gaps. In this video, I'm going to show you exactly how I use fair value gaps inside my Trinity model, how they fit into bias, high time frame context, and execution, so they become part of a mechanical, repeatable process instead of a guessing game. So if you've tried trading fair value gaps before and felt they were hit or miss, this will explain exactly why and how they're designed to be used. Before we talk about strategies or models, there's one reason most traders misuse fair value gaps from the beginning. Most people can't properly draw a fair value gap on the chart, let alone understand how it works. If you don't understand how they form or what their purpose is, you'll never know when it's actually time to take a trade. So let's break down how a fair value gap actually forms on the chart. Fair value gaps are not random. They come from a very specific 3 candlestick sequence: candle 1, candle 2, and candle 3, in which the wick of candle 1 and the wick of candle 3 do not touch, which leaves behind what we call a bullish fair value gap. Now, I say this is bullish simply because this middle candle here displaced higher, and that's where we had the gap between these two candles' wicks. This forms because one side of the market was completely in control. In other words, buyers had more control in how price was delivering than sellers did. Therefore, it left behind this gap, or what is also called an imbalance. We then have bearish fair value gaps. This is when we have, again, a 3 candlestick pattern in which the first candle's wick and the third candle's wick do not overlap. This provides us with our bearish fair value gap. So if price trades back into this gap, we will expect it to push price lower. This is because, again, there's unfinished business in this gap that needs to be rebalanced because price was in such a hurry to go lower. Now, if you'll notice here, I did this diagram very particularly. Here, we have a 2 candlestick pattern in which we have 2 candles that have overlapping wicks, but no overlapping bodies. This area right here is what we call a volume imbalance. A volume imbalance works exactly the same way as a regular bearish fair value gap. And in fact, if this were on the bullish side of things, it would work the same way there too. Meaning that if price trades back into this gap, again, we expect it to push price lower. Now, if you'll remember, we had a 3 candlestick pattern with our bearish fair value gap, but we also had it attached to a volume imbalance. Anytime this happens, all we have to do is get rid of this and extend our fair value gap drawing to include the volume imbalance. So now our gap will cover this whole area instead of just here. This will be very important for our distinctions later. Now, what happens when a bullish fair value gap gets closed below? Anytime we disrespect a fair value gap and close below it, it becomes what's called an inversion fair value gap, or an IFVG. When this occurs, we're no longer expecting this to push price higher. Instead, we're expecting price to push lower. The exact same thing goes with a bearish fair value gap. If that gets closed above, it means that it disrespected this bearish fair value gap and turned into an inversion gap. And again, we will no longer expect this to go lower. Instead, we will expect this to push price higher. It's important to remember these two as well. So now you understand how fair value gaps form. But here's where things start to separate beginners from traders who actually understand the market. Because if fair value gaps form the same way everywhere on the chart, then the real question becomes, how do we use that information correctly instead of treating every gap equally? And that comes down to time frame and the fractal nature of the market. When I say the market is fractal, all I mean is this. Price behaves exactly the same way on every single time frame, from the weekly chart all the way down to my 1 minute, all the way down to my even 1 second chart. So if my weekly looks exactly the same as my 1 minute, how can I use that to my advantage? You see, a fair value gap on the 15 minute holds the exact same structure to my 1 minute. As you can see, they look exactly the same. And if you remember from earlier, when I spoke about those little volume imbalances, here's one of those sneaky volume imbalances. So we'll include that in our drawing. It doesn't mean they serve the same purpose. Higher time frame gaps give you narrative, while lower time frame gaps give you execution. For example, if price reaches into a 15-minute gap, the gap is telling you where price matters, but you don't need to enter on your 15-minute chart. Instead, you can drop down to your lower time frame like your 5-minute and find another gap to actually enter off of, which looks like this. Price retraces into this 5-minute gap and trades away from it, hitting that external liquidity and trading to a 3R. Now your entry is precise, you're not guessing direction, and you're aligning a lower time frame execution with a high time frame story. That's how you use fractals to your advantage. Same concept, different scale, clear hierarchy. And once you understand that, fair value gaps stop feeling random. They start working together. So now you understand why time frame matters. You've seen how fair value gaps repeat across the chart and across different time frames, and how higher time frame gaps provide your narrative, while your lower time frame gaps provide precise entries. But none of that matters if it's not organized into a clear process. Because random tools, even good ones, still lead to random results. This is where everything comes together. Instead of trading fair value gaps by themselves, I trade a 3-step process that tells me what I'm looking for, when I'm looking for it, and when I can enter. This is a framework I call the Trinity model. And once you understand how these 3 steps work together, trading stops feeling reactive and starts feeling intentional. The very first step of my Trinity model is to find a high time frame fair value gap, very similar to what we were doing earlier. Here, as you can see, I'm on my 15-minute chart, and I've drawn out 2 bullish 15-minute gaps. So what I'm going to do here is hop down to my lower time frame to see if we tag into either of these gaps. I'm here on my 1-minute time frame, and as you can see, we kind of traded straight through this first 15-minute gap. But that's okay because we're not entering on our 15-minute time frame. As you can see though, we do respect our lower 15-minute gap. So I'm going to take this off the chart and start looking at this. Now I have step 1 of the model, which is my high time frame gap. Once you've identified a high time frame fair value gap, you're not looking to enter yet, because knowing where price matters still doesn't tell you if the market is ready to move. This is where most traders jump the gun. They see price inside of a gap and assume that's enough. But there's one more confirmation I need before I can even think about execution. That step is SMT divergence. SMT divergence is a very simple concept. Here I'm looking at a NASDAQ chart. And as you can see, I've copied this chart over here, and instead of labeling this NQ, I'm going to label it ES. The reason I'm doing this is because the NASDAQ and the S&P 500 move in a correlated pair, which means that when NQ moves higher, ES also moves higher. When NQ moves lower, ES also moves lower. What I'm looking for is a crack in this correlation. For example, when NQ creates a lower high and a higher high, while ES creates a higher high and a lower high in the same spot. This is exactly what SMT divergence is. Whenever we have the crack in correlation between 2 correlated markets, telling us that smart money is ready to reverse. Now, the way I use this is very simple. I align it with a high time frame fair value gap. So if this is my 1-minute time frame and price reaches up into a high time frame gap and provides SMT, now I can start to look for my actual entry because I know it's time for the market to start moving. Looking back at this example, now we can start to look for that divergence because we're inside of our high time frame fair value gap. As you can see here, NQ is making a higher low and a lower low. I'm going to mark that out right here. However, on ES, you can see that we're creating a lower low and a higher low in the exact same spot on our 15-minute chart. This is that divergence that I was speaking of, because we have it as we dig down into this high time frame gap. So now we have 2 out of the 3 confirmations that we need to actually take a trade here. We have our high time frame gap, we're respecting it, and we have SMT to confirm it's time to take a trade. So once SMT shows up, we finally have alignment. We know where price matters, we know the market is losing strength in one direction, but even now I'm still not entering because confirmation does not mean execution. There's one final piece that tells me when to step in and when to stay out. This is where most traders rush the move or completely miss it. And it comes down to how price reacts after SMT. That is where inversion gaps come in. Taking a look at this 3-minute example here, we formed a 3-minute bearish fair value gap as we tagged into our high time frame gap right here. But you have to remember what I said about those sneaky volume imbalances. As you can see, we have one right here, so we're going to include that in the drawing. Now we can't do anything with this yet. We have to wait for price to close back above this level. Once that happens, then we can finally take our trade. As you can see right here, we get a closure above the top of this bearish fair value gap. This now becomes an inversion gap, and I can set this as my entry. Basically, market entering as soon as we close above this gap. My stop loss is going to go below the SMT, and we will target a 2R. Let's play this out. As you can see, it took us a second, but we did make it to that target. That's exactly how I take a high time frame gap and use it to enter on my low time frame. So at this point, you've seen the full structure. High time frame gaps give you narrative, SMT divergence confirms this narrative, and the inversion gap gives you your entry function. That three-step process is my Trinity model. Now, if you're watching this and thinking, I understand this conceptually, but want help applying it the right way, that's exactly what my mentorship is for. It's where I walk through this model live, in real time, and explain exactly how I trade it. No guessing and no strategy hopping. You get direct one-on-one mentorship from me, multiple calls per week, every single one of your trades gets reviewed, and you get quizzes and tests to make sure that you're on track. If that's something you want more details on, the link will be in the description. I also recently made a full course on YouTube covering exactly how I would start day trading as a beginner in 2026. If you want to watch that, there should be a pop-up right here. And if you guys enjoyed this video, I would greatly appreciate you like and subscribe and turn that bell on for notifications for future videos. Thank you guys for watching, and I will see you all in the next one. Peace.